It's 2:17 a.m. A bank is dying. Not in a dramatic Hollywood way. No alarms, no smoke. Just numbers moving across screens and one problem that sounds boring until you realize it can erase a company, a paycheck, or a savings account before breakfast. People don't panic because a bank lost money. They panic because a bank runs out of time. And when that happens, there's a quiet blueprint that shows up again and again. It doesn't look like a bailout. It rarely uses the word rescue, but it does something even more powerful. It moves the risk out of sight, so the public stays calm. Markets keep opening on Monday, and the people who were supposed to lose don't always lose. Let's talk about too big to fail, not as a slogan, as a machine. Because the uncomfortable truth is this: too big to fail is not just about size. It's about how the system is wired to protect certain flows of money at all costs, and how that protection changes who takes the hit when things go wrong. And right now, this matters because the modern financial system has become faster, more interconnected, and more dependent on confidence than ever. Confidence is the product, and it's fragile. Here's the setup. Imagine a bank like a restaurant. You walk in, you hand them cash, and they promise whenever you want, you can come back and take it. But the restaurant doesn't keep your cash in a drawer. It uses your cash to buy things, to invest, to lend, to earn. That's not evil. That's banking. The trick is, a bank promises you instant access while using your money for long-term bets. That mismatch is manageable until it isn't. Because if too many people ask for their money at the same time, the bank can't say, sure, come back in 6 months when our investments mature. It has to pay now. So banks survive on one invisible ingredient: the belief that you won't all show up at once. Now add modern reality. In the old days, a bank run meant a line outside a branch. Today it's a group chat. It's a few tweets. It's a founder texting 20 other founders. And then 1,000 people try to leave at the exact same time by tapping a screen. That's not a metaphor. That's a mechanical upgrade to panic. And here's where too big to fail stops being a theory and starts being a blueprint. Because when a bank is about to collapse, regulators don't ask one question. They ask two. First, should this bank fail? Second, can we allow the chain reaction? Most people don't realize those are different questions. Sometimes the bank can fail, as long as the money pipes stay open, as long as payroll clears, as long as ATMs work, as long as other banks don't start dying from fear. So the system has learned a move that's almost elegant in how cold it is. It isolates the parts of failure that could spread, and it protects those parts, even if it means shifting the cost somewhere else. Let's walk through how that actually works, step by step in plain language. Step 1, define what must not break. In a crisis, policymakers care about the basic plumbing: deposits, payments, short-term funding markets, critical contracts. If those freeze, the economy doesn't slow down, it seizes. So the top priority becomes preventing a freeze, not saving the institution's pride, not saving shareholders, not saving the CEO's reputation, preventing a freeze. That's why, in March 2023, when Silicon Valley Bank collapsed, U.S. regulators didn't say, everyone will be made whole because we love banks. They said depositors will be protected and no losses will be borne by the taxpayer. That's a direct line from the joint statement by the Treasury, the Federal Reserve, and the FDIC. You can read it on the Fed's website. http://www.federalreserve.gov. News events, press releases, monetary 223032B. HTM. That sentence is doing a lot of work. Because people heard, no taxpayer bailout. But the system heard, we are preventing a deposit panic. And it did, by using something called the systemic risk exception, which is basically the regulator's emergency lever that says, if we don't protect this, it could spread. The FDIC's own press release about SVB is also very explicit. Uninsured depositors were protected. Shareholders and certain unsecured debt holders were not. And any losses to the deposit insurance fund would be recovered by a special assessment on banks. It's right there on FDIC.gov. https://www.fdic.gov. News Press Releases 2023 PR 3019 HTML. So what happened wasn't a magical escape from losses. It was a rerouting of losses. Step 2. Separate the bank into safe stuff and burning stuff. When a bank fails, you don't just smash it with a hammer. You split it. You create a bridge bank. Think of it like taking a crashing airplane and quickly moving the passengers to a new plane mid-air. While the old plane continues crashing off-screen, deposits move to the bridge bank. Essential operations continue. People,